Measurement fundamentals continued. There are two different approaches you can take to accounting, either a cash basis approach or an accrual basis approach. The cash basis approach is primarily used by individuals and small businesses. It is not used by corporations or any large business entity. It's not permitted for revenue and expense measurement or reporting under generally accepted accounting principles, also known as GAAP. So GAAP means generally accepted accounting principles. Under cash basis, revenues are recognized only in the period in which cash is received. So if you get cash is received, that means there is revenue. So if you and I think about it, when we get a paycheck, it's revenue to us. If a cash basis business receives cash from a customer, they recognize revenue from that customer. Also, under the cash basis, expenses are recognized only when cash is dispersed. So when cash is dispersed, you have an expense. So when you pay for, say, supplies, they go into supplies expense, since you bought them and immediately it's assumed that they're used as well. Notice that cash basis income statements report cash received as revenue and cash expenses as incurred. Now, the cash basis income statement is not comparable to the cash flow statement under accrual accounting or the income statement under accrual accounting. So cash basis just for individuals and small businesses. The alternative to this, or the other option, is accrual accounting. And accrual accounting is what is used for any large business or corporation. It's very interested in matching the efforts of a business or its expenses with its revenue or its rewards of being in business, its benefits for being in business. And we know that that's the income statement, that we're comparing the efforts with the benefits for a period of time. And that's called the matching concept. And it's very important when we do the timing of our revenues and expenses that we only include in this period of time those revenues that are earned during the period and match the expenses that were incurred against those revenues for that period of time. So notice that we want to use accrual accounting because it accurately measures the revenues and expenses for each accounting period. Now, accrual accounting's income statement matches revenues earned, which is the key question here, not the cash coming in or the cash going out. Notice that in addition to having a balance sheet and an income statement in accrual accounting, we also have a statement of cash flows. And that statement of cash flows looks at the sources of cash, or the cash inflows, and the uses of cash, or the cash outflows, for the period. And those inflows and outflows of cash are not what shows up on the income statement. So I hope this is helpful to compare and contrast cash basis accounting with accrual basis accounting.